Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Bird Construction stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Bird Construction provides construction services to all types of sectors, including energy, mining, commercial, retail, nuclear, and many more. The company is headquartered in Ontario, Canada, and was founded in 1920. It went public in 2000 and currently trades on the TSX and Pink Sheets. It is one of the top 10 general contractors in Canada. Let's get started with the model. This is a small cap company, 493 million market cap. They're trading at $9.29 a share, and they have 53 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They have negative free cash flow every year, except in 2018, positive 87 million. Net income is the profit and loss on the income statement. It's revenue minus expenses. And it's positive every year except in 2018, it was negative 1 million. Revenue is the sales for the company, and that's pretty steady, around $1.4 billion every year. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. And the difference between those two numbers is their gross profit. Their gross profit is the highest in the trailing 12 months at 91 million. Then below that is operating expenses, then operating income. And they do have positive operating income every year except in 2018. When you look at the income statement, you should focus on operating income because the stuff below that is not part of your operational business. Below operating income is the interest they pay in their debt. And they seem to be paying more interest each year. It's up to 5.7 million. Below that is other income and expenses, then pre-tax income, their taxes, and the bottom line of the income statement is their net income. And they do have positive net income every year, except in 2018 it was negative. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. They have negative operating cash flow every year except in 2018. Then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus capex gives you your free cash flow. Since the company has negative free cash flow, they're using debt to fund their business. They issued 72 million in the trailing 12 months. They did pay down 40 million, so they added $30 million. They added 12 million in 2019. And they added 8 million in 2018. Let's look at the capital structure. $196 million of equity, 277 million of debt. They're 41% equity, 59% debt. Their net debt is 119 million, and their WACC is 8.7%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 1.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.5 billion. We divide that by 53 million shares. And we get a calculated stock price of $29. They're trading at $9, so they're trading at a 68% discount. It's a strong buy according to the model. Simply, Wall Street's valuation is really close to me at $29. They're also saying the stock is really undervalued. The way I valued the company was using analyst estimates. Analysts are expecting the company to have positive future free cash flows. If this does happen, the stock could go way up. This is a stock price the last 5 years. So you can see it was about $13, $14 back in 2016. Then it came down to under $5 it looks. But it's back up over $9. This company has a beta of 1.32, so the stock moves a little more than the market. It's not too volatile. The stock has gone up 66% in the past 52 weeks. The S&P 500 went up 27%. The 52-week high was $9.50, the low was $4, and the stock is trading above its 50-day and 200-day moving average. About 100 to 200,000 shares are traded each day on this stock. Of the 53 million shares outstanding, 52 million are on float, 42% are held by institutions, and hardly any shares are shorted, 0.2%. If you invested $10,000 into this company 10 years ago, you'd be at $2,800 today. That's a pretty bad return on investment. The biggest shareholder owns 19%, then 10%, 3%, 2.4%, then 1.7%. Let's look at the financial ratios. The average PE in the market's 9, the median is 14. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 20.8, so investors are paying $21 for $1 of earnings. Price to sales is stock price over sales per share. They're at 0.4, so they have a great price to sales ratio. Price to book is stock price over book value per share. They're at 2.5. They also have a good price to book ratio. And the way you calculate book value per share, it's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and they have 200 million of equity, 137 million of tangible equity, since they have 59 million of intangible assets on their balance sheet. Interest coverage ratio is EBIT over interest expense. They can cover their interest payments almost 4 times. ROE is net income over equity. They have a 12% ROE. Current ratio is current assets over current liabilities. They can cover their current liabilities with their current assets. And their current assets are 157 million of cash and 800 million of receivables. They seem to have enough capital to get through the next 12 months without taking on any more debt. They did have negative 26 million of free cash flow, but they have 118 million of working capital and a $21 million dividend payment, so they have $71 million of funding. They pay a monthly dividend of 3 cents. Their dividend yield is 4.25%, and they pay out 88% of their net income. The best way to look at ratios is to compare them to companies in the same industry. The only other company I did in the same industry was IEA, and Bird is better in PE. They're both really low in price to sales. IEA is a little better. Bird has a positive price to book. IEA has negative equity, so they have a negative price to book. Both are doing fine in current ratio. Bird has a positive ROE. Bird is doing better in debt. And they're both really small companies. Bird is a little bigger. And Bird does pay a dividend, IEA doesn't. So to summarize, I have them trading at a 68% discount. These really small microcap stocks don't get as much attention as the bigger stocks. So based off of analyst estimates, the company may start generating positive free cash flow, but that doesn't mean the stock price will go up. The only way the stock price goes up if investors start buying the stock and push the price higher. This company has been around a really long time, over 100 years, so I don't think they're going anywhere. I rank their free cash flow as 1 out of 10, their revenue 3 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.